This is the current federal tax developments for the week of February the 29th, 2019, or 2016. Get the right year in here. Current federal tax developments are brought to you by your state society of CPAs and Nichols Patrick CP Incorporated. Be sure and take a look at what we have available at currentfederaltaxdevelopments.com, which is where you're going to find information related to this week, as well as other information related to things that we're presenting. Now, with that, let's go ahead and get started with this week's developments here, dealing with the area of federal taxes. We're going to start out with a number of different developments that took place during the week. And the initial one we're going to start out with here is actually not going to be necessarily what you might consider a federal development, but it's going to be a kind of important development with state taxation. And you might think, well, wait, we talk about federal taxes here. Why are we talking about states? In this particular case, though, it deals with a federal issue as to whether the state of Colorado's provision they enacted to try to deal with out-of-state sales or sales by out-of-state entities into the state of Colorado violated what's known as a dormant commerce clause. This will be, in fact, should be very important to your clients who sell into states other than those where they have a physical presence, because what this may require is a bunch of additional reporting. So we'll talk about the case. The issue here involves the Direct Marketing Association versus Brohl is the case in question. It's a 10th Circuit case, case number 121175. It was brought down by the court on February the 22nd. In this particular case, what happens is the state of Colorado requires sellers who are not collecting sales tax in the state to inform buyers of their use tax obligation and report information on those buyers to the state. The question became whether the state of Colorado can do that. So the example would be, let's say I'm a business operating in the state of North Dakota. I don't have anything to do with Colorado, but I do maybe send catalogs to Colorado, or maybe have a website so we collect information on the web and we get orders from Colorado. I ship goods to Colorado. The Supreme Court in the Quill case a number of years ago held that a state could not, in fact, force that out-of-state company, even if it was sending catalogs into the state and marketing to the residents of the state, could not force that company to collect a sales tax or use tax and remit that to the state. That was a case where the state of North Dakota had attempted to do that. The Quill case found that that violated what's known as the Dormant Commerce Clause of the U.S. Constitution. The Dormant Commerce Clause is actually, as the 10th Circuit opinion explains to us, not really anything you'll find in the Constitution. It just deals with a situation where the Congress has not spoken to an item that affects interstate commerce. And because of that, we have to decide whether the states have the right to step in and do this without congressional authority. And there's been a number of case law tests developed based upon how invasive it is. Under Quill, it was pretty obvious that you couldn't force a company to collect sales tax in your state unless Congress passed laws authorizing that, because the Supreme Court held, based upon a history going back to the Bella Hess case, that this violated the Dormant Commerce Clause. It was considered to be too impactful in interstate commerce, so the states couldn't get into this unless Congress said we're okay with it. Now the question becomes, can Colorado require them not to collect the tax, but rather simply to remit information about their buyers and provide information to their buyers? And in this case, the 10th Circuit Court found that this particular requirement does not overly burden interstate commerce and does not therefore run afoul of the Dormant Commerce Clause of the U.S. Constitution. That's an issue because what it tells us now is that the state of Colorado, this particular law has been on hold in the courts. Now it tells us that the state of Colorado effectively can begin to attempt to enforce this law, and the 10th Circuit feels that it's fine. Now, remember that this doesn't tell us how other circuits feel, but the 10th Circuit includes states such as Kansas, New Mexico, Oklahoma, Utah, and Wyoming. So we could reasonably expect that at least those states will probably move forward here in the next year or two and pass similar legislation to that passed by Colorado and require sellers to collect tax. Not collect tax, but to collect information and forward that to the Revenue Department. Obviously, in all these states, probably in the alternative, you'll have the option to simply collect the tax. And from a practical standpoint, that may actually be simpler. But watch out for these particular rules and how they come down. Also key, if you are located in a 10th Circuit state, The question no longer becomes whether the other state, for instance, Colorado, if you're a New Mexico company, or let's say you're a New Mexico business, now there's no question the 10th Circuit says the state of Colorado has the right to require that New Mexico company to provide the information. It's for the moment slightly less clear how this would work out if let's say the company was here in my home state of Arizona, which is in the Ninth Circuit, because we don't know if the Ninth Circuit is going to feel that this particular rule is overly burdensome or not. We would fully expect the Direct Marketing Association, I would suspect, is going to try to get the Supreme Court to hear this thing, because as the concurring opinion predicts, if in fact virtually all states with a sales tax would be crazy not to adopt this rule. And that may mean that your clients have to worry about any state they ship items into. They may start to have to worry about reporting obligations to those states and also information they have to provide. The court concluded actually, and if you read the Quill opinion, it's probably reading Quill, at least the implications of Quill correctly, that the Supreme Court decided Quill the way they did just because, well, we have the old Bella Hess case, and we think that probably it went too far, but we really don't want to change that. So they read Quill very narrowly. What they said in this case, very simply, Quill only deals with collection of a tax. In this case, they're not asking them to collect a tax. Therefore, Quill is not impacted by this, and therefore, the state of Colorado is within their rights to require anybody selling into the state of Colorado to provide this information. Next up, we have a case here that actually deals with something that quite often you see some clients try to do. This is Key Carpets, Inc. versus Commissioner, Tax Court Memorandum Decision 2016-30 that came down on February the 25th. This deals with problems that arise from related entities. When your client has set up a company and then your client goes out and sets up another company. That happens from time to time for various reasons. In this particular case, Key Carpets set up a related company called Clean Hands. Key Carpets was developing a hand washing machine for the food service industry. This hand washing machine they were developing would use RFID, radio frequency ID tags, that the employee would have that on a card with them when they went up and had to wash their hands. Of course, they went to the restroom. They're supposed to wash their hands coming back out. They would have to go up, tag the card. It would recognize the employee is there. It would record that the employee had, in fact, washed their hands because it would then dispense the soap, etc. Everything would be recorded. Now, after establishing this company, which, as I said, was called Clean Hands, primarily it was established to hold the name. Key Carpets never actually got this machine off the ground, but they kept working. So for 11 years, this corporation, Clean Hands, stands dormant. After 11 years, Clean Hands hired an employee. It was an IT technician, computer technician, and he was hired because he wanted to develop the product. Now, he was put on Clean Hands payroll. But Key Carpets was paying over in the 2 years in question, over six figures in the $100,000 plus range of fees to Clean Hands, supposedly because this gentleman was doing work and Clean Hands was developing a new, not RFID based, but rather voice actuated system that would do the same thing. The IRS challenged this, saying that this was not properly an expense. This was not an expense of Key Carpets, that in fact, Key Carpets got no benefits from this. The tax court actually agreed. What the tax court found was that in fact, there was no evidence the paying corporation owned the asset in question. A couple of problems came up. The key one was that the patent was held by the shareholder individually. It was not held by Key Carpets. Key Carpets didn't have any employees working on this project. We rather had this IT guy off to the side working on the project in Clean Hands. And the court said there's no evidence whatsoever except this testimony of this guy vaguely that Key Carpets had anything to do with this. Now, we don't know for sure, but it seems very likely that the problem here was that Clean Hands had no income and Key Carpets had income. So what he was doing was basically when he paid the fee over, that put expenses on Key Carpets. And obviously there's a tax assessment here. So Key Carpets, there would be tax paid if Key Carpets doesn't get the deduction. But very likely Clean Hands just has losses and We don't know for sure, but it seems likely it's a C corp, and this C corporation with no income, that loss is simply going to sit there and carry forward but have no current benefits, so we're going to pay extra tax each year. The problem here is that the taxpayer had established these multiple entities. The taxpayer did not pay a lot of attention as to things like who had the patent. Well, maybe he did, but that was part of the problem because he wanted the patent personally, not inside these companies. He had no agreements where Key Carpets licensed the patent or did anything else, apparently, that would cause it to have ownership interest. It seems very likely that what he was doing was simply trying to, balance or get rid of having to pay excess taxes by not having losses in one C corp and income in another C corp, and he had them both filing separately. Clients have to be aware that when we have related enterprises, it's very important. The taxpayer themselves has to make sure that they follow the form. Taxpayers are allowed to set up the form any way they want to. They can arrange their affairs as they wish, but once they've arranged them, they've got to respect the arrangement. Quite often, that's where our clients get into trouble because after setting it up, they just very naturally say, well, I own 100% of Key Carpets. I own 100% of Clean Hands. I own 100% of the patent. Really, this is all the same thing, right? So I can just rearrange things as I wish. No, when you establish those two entities, you need to be concerned about what each of them has and what legally each of them has. And you have to very carefully recognize the form. In this case, the form was not carefully recognized. And because of that, these six-figure deductions were lost. And the taxpayer ends up not only with the tax, but also the penalties on the understatement. Next up, a little interesting question that apparently was concerning some agents at the IRS. So, hey, we decided we'd get an answer for this. This is Chief Counsel Email Advice 2016-02012, issued on February 19th. And what this deals with is an issue where a taxpayer is going to make a contribution of collectible U.S. coins. These coins are still legal U.S. tender, but on the collectible market, they have a value that is way above their tender price. So let's say we have a dollar coin, but it is a coin that may fetch $500 on the collector's market. Generally, under Section 170, we need an appraisal anytime a contribution of property with value greater than $5,000 is made. But we have the exception that we find that says that you do not have to. Under Section 170 F11A II, no appraisal is needed for readily valued property. And generally in the regulations, cash, a contribution of cash, is referred to as an obvious example of readily valued property. A gift of $500 cash is readily valued at $500. We don't need an appraiser to come in and value the stack of bills. But the question became, in this case, this guy is now going to make a contribution of what is, without question, cash. It's legal tender in the U.S. So he's going to make a contribution of cash, but he's not going to claim the $1 value. He's going to claim, let's say, the $6,000 value that these coins have. So instead of being $20 worth of coins, there's $6,000 is worth of coins. So it's $20 face, $6,000 in collectible value. Is an appraisal needed? The national office said yes, an appraisal will be needed for these coins if a taxpayer attempts to claim a value for the coins that's in excess of the face value of the coins. If that's true, and if the value of the contribution exceeds the limits, like the $5,000 limit in this case, you have to follow all of the rules, including getting the qualified appraisal. I don't find this terribly surprising, but apparently at least somebody in the IRS was concerned, or potentially I would assume some taxpayers had tried to argue that, well, it was a gift of cash and we don't need an appraisal for cash. Might have been a cute idea, does not work. Or I would say, I'll put it this way, I don't disagree with the conclusion of this email. I think you're going to have a really tough time in tax court if you tried to argue that this was a contribution of cash and you could get out of having to have an appraisal. Don't be surprised if you tried that, if the tax court said, okay, that's right, no appraisals needed. You gave $20 in U.S. gold coins, therefore you get a deduction for $20. You sometimes be aware of what you ask for. The IRS, interesting this week. Sometimes, they put questions this year on the Form 5500 series forms. And now they've decided maybe they don't need that information. So this week, the IRS on their website published an announcement that it's determined that it does not want you to fill in certain information on the 5500 series forms. Now, basically, some of those things that they do not want completed is interesting. If you go online, you'll find it. If you go to Form 5500, prepare information at the page 1 bottom, they claim they do not want. They don't want Schedule H, line 40 to P, and 6A to D. Schedule I, lines 40 to P or 6A to D. Schedule R, new part 7, lines 20A to C, 21A to B, 22A to D, and 23. Or Form 5500 SF, prepare information, again, page 1 at the bottom, lines 10, 14A to D, and new part 9, lines 15A to C, 16A to B, 17A to D, 18, 19, and 20. Apparently, the IRS has decided that they don't want that, but they decided it wasn't worth going back and actually reissuing the form. So the form will have that on it, but it won't print out. The most important thing to remember is it'll be highly likely that your tax software now, even if you've entered into those fields, won't print anything there, or they'll simply remove those line entries. So this could be interesting. So if you get a 5500 when it comes out of a system and you notice, hey, those aren't answered and you can't figure out why your software won't let you answer them, you might want to go check this list. That's the reason why you're not going to be allowed to answer those questions this year, because the IRS has told us they don't want those questions answered. Next up, we're going to deal with liabilities in a partnership. This is Private Letter Ruling 2016-08-005, issued on February 19th. This questioned whether or not we had payments to precede payments under a contract represented partnership liabilities. As we should be aware, whether something is a liability in a partnership has a significant impact, because if something is considered a liability, it adds to the basis of taxpayers. At least some partner is going to get additional basis if it's considered liability. In this case, the organization had a contract where they received 2 types of payments under the contract. First payment, and it was a construction contract, they had normal payments that were paid as they completed various parts of the project. So, when they got to point A, and let's say they had reached a certain milestone in the project, the first payment was due. When they reach point B, they would make the second payment. Those payments are not what's at issue here. However, the contract provided for a specific thing called a payment to proceed payment, where when they told the contractor to begin construction on specific phases of the contract, they had to put money in immediately before the contractor did anything. The question became, were these considered liabilities under the contract? Now, as always, this is considered a very fact-specific ruling, so we have to look at the details of the contract. In this case, the key issue was, is it an obligation? And this liability exists to the contract. What they decided was this particular payment, remember, it's made before any action's taken. If in fact the contractor never ends up going forward with the project or fails to complete, they're going to owe the money back. Now, even though nothing was ever structured as a loan, the client, the customer did not give a loan of $40,000, let's say, to the contractor if he makes a $40,000 payment to proceed payment. It's treated as a liability. The IRS looked back to Revenue Ruling 95-26 on short sales, where they concluded similarly a short sale, the outstanding balance, to conclude a short sale is a liability, even though there's technically no direct loan took place. They said conceptually this is very similar. The obligation that is involved to complete the contract, the obligation creates a liability, and that liability therefore can be used on the partnership return and should be treated as a liability on the K-1s. So we're going to allocate that. Now, again, as always, you've got to make sure you allocate that to the proper partners, but that's a whole nother long discussion as to how that would be handled. Next up, the long-awaited final regulations on reporting on foreign assets held by certain entities was issued by the IRS this week. Treasury Decision 9752, issued on February the 22nd. What this ruling gives us is organizations that will be required to file Form 8938. The 8938 is what you file when you have assets in a foreign country, right? Financial assets in a foreign country. This is not the F bar. This is the fact, this is a factor requirement. So remember, we got those two pairs. This is what will go with the tax return. You may remember recently we've always been told for entities, don't worry about that yet. We'll get back to you. Now the IRS has gotten back on the final regs. Under these rules, only certain entities are required to file the forms because that's what the law says. The law provides at Section 6038 Cap DF provides that it only applies to certain entities. It applies to a domestic entity which is formed or availed of for the purposes of holding, directly or indirectly, specified foreign financial assets. And by the way, specified foreign financial assets are those things that the individuals always had to report on the 8938. And the IRS would issue regs. The IRS had issued proposed regulations that had two tests in them. First, if an entity had more than 50% of its assets, basically, 50% of its assets or 50% of its income came from passive income arising from foreign assets, then it was considered to be a entity, this type of entity that has to file the form. Or if it had 10% income or assets that came from foreign, and a principal purpose of the formation was to avoid filing the forms, then it had to file the forms. A lot of people protested about the second test because that, we have a bright line test on the first one, the 50% rule, but the second one, anytime you get above 10%, you might need to file, but we're not sure. Will it be deemed to be principal purpose? Of course, that means in a lot of cases, a lot of people would end up just filing the form the minute you went above a 10% just to avoid the problem. That would generate a lot of forms. And they said that's not necessary, but we're going to obviously have to tell people protectively to do it. So in the final regulations, they only contain the 50% passive income test. And they got rid of the 10% test that had a principal purpose component. That's gone. So principal purpose no longer is a test. That's kind of interesting because, of course, as you remember, the actual law talked about the principal purpose. What the IRS is saying, we're going to use the 50% rule, and it's deemed, we're just going to define principal purpose as an entity that has more than 50% of these. As you might note, that's an annual test. So an entity can go above or below the 50% each year. It also made a definition of what's considered passive assets for this rule. And they did previously, they had a slightly different definition than the one found in Section 1472 of the code. Now they're going to basically tie it in with that withholding section provision. The same definition of what's considered passive assets is the same as is true on the withholding provision. And the list of them is found in the regulation. It's also found if you go to currentfederaltaxdevelopments.com. In our write-up, we have the list there as well as a link to the regs themselves. They also tell you how to compute the average assets. It's a weighted average basis computation that's defined in the regulation is how you'll do the 50% foreign asset test. This will apply in this case, the actual application date on this. This applies to tax years beginning after December 31st, 2015. So we won't do this for 2015 filings for these entities, but you are going to have to get ready in 2016 to begin filing the 8938 information for entities that meet this test. Not a bad idea to sit down and during this coming year, work out with your clients, do we have entities that look like they could meet this test? If you have clients that have lots of entities, some of which are holding these assets of this type, you want to go back and make sure that you take a look at what entities are going to pass the 50% test and have to file this form next year, and make sure you discuss that with any affected clients. Next up, one more left to go. We have a McAllister versus United States, a Court of Federal Claims case number 1:13 CV 01026, issued on February 23rd. This takes a look again at the financial disability provisions of Section 6511H. That provision, remember, generally a taxpayer who has a financial disability, let's say they had mental problems, severe mental problems, they had a severe illness, for whatever reason, they were unable to file a return. If they end up filing it so late that they would lose their refunds, but they can show they had a financial disability, the statute's suspended while they have a financial disability. The problem is that is a very narrow exception. And we've seen it before because we had, back in 2015, Chief Counsel Memorandum 2015 15019 discussed this in a different context, that dealing with filing for net operating loss refund claims, where the person had a financial disability, let's say for 5 years. Now, 5 years later, he files a return that generates a loss. He has to carry it back 2 years. That Chief Counsel advice noted that the statute for the 2 years you carry back to was not a statute that was cross-referenced in 6511H. And because of that, while you could get any refund from the year you had financial disability, you couldn't get a refund from the carryback, even though you're statutorily required to carry it back those 2 years. This is a slightly different problem with NOLs. This particular case is the taxpayer was disabled or claims to be disabled for 2009. The court never decided if he was, because the court finally decided that was a moot issue. He filed a return late for that year. Now, you may remember in 2009, that was when we had the right to file a carryback of more than 2 years if we elected, from 2 to 5 year qualifying small business. Well, he failed to file the election for the longer carryback period by the extended due date of the return. Section 172 of the code, net operating loss, with the provision that added this, specifically said any election to go more than 2 years back had to be filed by the extended due date of the return. Well, he said, wait, I was financially disabled. And so because the statute was held up in my 2009 return, I should still be able to make this late election. The court found, sorry, guys, Congress very specifically limited the relief on 6511H. And if you read the write-up we have this week, we talk about the specific, very tight specific cross-references that they had as to what they extended, which is not this. The election provision in 172 is not mentioned anyway, directly or indirectly, as being extended by 6511H. It, therefore, the court held was not extended. The theory being, if Congress wanted 6511H to extend all statutes, they need to go back in and write a brand new law. They've not done so. Because of that, the Congress is just going to have to live with the fact that, you know what, world works this way. Taxpayers, sorry, Congress gave you a break, but it was a very limited break. And sorry if that limited break isn't good enough for you, but hey, guys, you have to live with what they gave you. This has been the current federal tax developments for the week of February the 29th, 2016. You can visit us online at currentfederaltaxdevelopments.com to get information about things that are going on this week, as well as all the citations for this week's work and information, links to the source documents. So you can get some write-ups. We'll get links to source documents. We'll find out lots more. You can also find information, as you'll get there, about updates as things develop in the current week. So if you want to go there, find out what we're doing, we'll give you those write-ups. We've also added an ability for you to go ahead and sign up for our newsletter. As we post articles during the week, you will get information there. If you go to the website, you'll see a link that says newsletter. Click there, you can sign up, and you'll get emails coming any morning where we've added something to the site. So if you want to read the articles as they come through during the week, you can find it there. If you have any questions or comments about the podcast or any other information that we've got here, you can send me an email. That's Ed Zollers at currentfederaltaxdevelopments.com, and we can take it there. We look forward to seeing you next week and talking to you about the developments that occur in federal taxes in the coming week.